Top stories live from the Sky News City studio. Government borrowing surges as inflation pushes up interest payments on the national debt. Grocery inflation eases for a second month as the cost of milk falls. French billionaire Patrick Drahi raises his stake in BT. Plus a rebound in the food services sector. I'll be speaking with the chief executive of SSP Group about a return to profit and a new partnership with Brewdog. Good morning, this is Ian King Live, an hour of business and economic news from the heart of the city. Interest payments on the national debt, swelled by the soaring rate of inflation, meant that UK government borrowing came in higher than expected last month. The government borrowed £25.6 billion in April, the first month of the new financial year, which was ahead of the £22.4 billion that had been forecast by the Office for Budget Responsibility, and it compared with £13.7 billion during April last year. It was the second highest April borrowing since monthly records began in 1993. The Office for National Statistics said the increase was driven partly by the government schemes to support households with the high energy bills and increases in benefit payments. But the ONS also flagged higher interest payments on the national debt, a portion of which is linked to inflation. Interest payments on the national debt hit £9.8 billion in the month. That was up £3.1 billion on April last year, and it was the highest April figure on record. Now, falling milk prices have helped bring grocery inflation slightly lower for a second consecutive month. Kantar World Panel, which tracks supermarket sales and prices, measured the annual rate of grocery inflation at 17.2% for the 4 weeks to the 14th of May. That was down from 17.3% during the previous 4-week period, but it was still the third highest level since the 2008 financial crisis. Well, joining me now is Fraser McKevitt. He's Head of Retail and Consumer Insight at Kantar. Fraser, welcome to you. Are you surprised grocery inflation isn't coming down more rapidly?
Yeah, it's a little bit disappointing, isn't it? And we know grocery inflation lags the more general rate of inflation because it takes a while for things to get from the field through the supply chain and onto the shelves and through the tills. So we are seeing some movement in the right direction. And there is some good news. So the headline around milk, so that's come down to about £1.60 for 4 pints, which is down about 5% on where it was just a month ago. That's great news, but it's worth bearing in mind. Might be down versus last month, but it's still considerably up on where it was last year. And inflation is typically a year-on-year measure.
Have you noticed any of the operators in particular cutting milk prices? I mean, traditionally, it's been a bit of a loss leader for the likes of Aldi and Lidl. And I mean, I've seen other supermarket CEOs refer to it. It's a category in which profits no longer are made.
Well, I think it's one of the few items and one of the few categories that people actually might be able to say what the price is. And it's so competitive, the market, that when one retailer moves it down, others will tend to match them on this particular product. And we know that in the last month, quite a lot of noise has been made from some of the biggest retailers in the land, the likes of Tesco, the likes of Sainsbury's on this product. So it is fairly widespread across the market.
Obviously, we heard last week from the Competition and Markets Authority they're not going ahead with a full-blown investigation into the grocery sector right now. I mean, as someone who watches this sector very, very closely, I mean, it's your job, basically. I mean, is that the right decision? I mean, competition is pretty intense, isn't it?
Yeah, whether you love supermarkets or you hate them, and we all have an opinion on them, you have to admit this is a very competitive sector. Margins are pretty slim here, so in the region of 2 to 4%. And we also, for the latest set of results, there are relatively few public limited companies in this space now as private equity has moved in, but both Sainsbury's and Tesco's reported that profit was down. So it doesn't, on the face of it, see that a market that is particularly profiteering at a difficult time for all their customers.
Now, we've talked a lot in the recent past about own brands taking off in the cost of living crisis versus branded products. You note today that the gap is narrowing.
Yeah, the gap is narrowing, but still quite wide. So own label products are growing about twice the rate of branded products, but that is coming down. We've seen brands get a little bit of a boost this month because Sainsbury's have launched their Nectar Prices initiative, which is very much focused on branded products if you use their loyalty card. And that has added quite a bit of the sales to the brands this month.
Now, obviously, this month was the coronation period. What special features did you see?
Well, there was a little bit of scepticism, wasn't there? Wasn't the nation going to get behind the coronation? And in the week of that, we actually saw sales go up by 16%. So whether people were celebrating the monarchy or just having an extra bank holiday weekend, we don't quite know. But during that time, it looks like more than £200 million extra was spent during that week. And no surprises, the big sellers, the things that really went up, sales of fizzy wine more than doubled, and still wine was still up by a third in that week as well.
And you noticed that Waitrose got a boost during the coronation week. I mean, that feels like people trading up.
Well, it does feel like that. And, we know that the Waitrose shopper typically tends to be a little bit older, which might well correlate with people who were enjoying and celebrating the coronation. But they were the retailer with the biggest uplift in that coronation week.
Also, looking at the market shares more broadly, one of the key points that you bring out is that Morrison's enjoyed its third consecutive period of sales growth. Can one definitively say now that it's turned a corner?
Well, it's really hard to say in this market because it is so competitive, but it's got to be good news. Now, they do still lag their rivals by quite a way, but they've been making a lot of noise in recent days. They're bringing back their More card, a physical card, moving away from an app. So I think their consumers might find it easier to use. And there's a lot of marketing going on talking about the prices that they're going to offer. So they certainly are making a really good effort to get the retailer back up to speed and back in the pack with their rivals.
I notice also Morrison's are offering some quite attractive promotions on petrol right now. Obviously that was one area that the CMA alighted on last week. Morrison's fighting quite hard in that particular corner of the market right now.
Yeah, and it is very competitive in petrol. And again, one of those few things that people might actually know the price of. And of course, there's apps that out there will tell you which retailer, be it petrol retailer or a grocery retailer, is offering the best prices. And we know that petrol does drive footfall to stores. I'm going there for my petrol. It's a big purchase. I'm maybe spending £50 and then I'll pop in for a few items, either to a convenience store that's just in that petrol station or pop into the main store as well.
All right, Fraser, good to see you as ever. Thanks for joining me today. Some other business news stories for you now. And the French billionaire Patrick Drahi announced this morning that he has raised his stake in BT from 18% to 24.5%. Shares of BT, though, have hardly moved on the announcement, and that is because Altis UK, the vehicle through which Mr Drahi has bought his stake, stressed he has no plans to launch a takeover bid. Well, Altis, which controls France's second biggest telecoms group, SFR, first bought a 12% stake in BT in June 2021, and it raised it to 18% later that year. The UK government subsequently investigated the investment under national security laws, but said last August it would be taking no further action. John Allen, the former president of the CBI, is stepping down as chairman of Barrett Developments at the request of the House Builders Board. The news comes 4 days after Mr Allen stepped down as chairman of Tesco and follows 4 allegations in the Guardian newspaper about his personal conduct. Well, 3 of those have been vehemently denied by Mr Allen, while he's unreservedly apologised for the 4th, which concerned inappropriate comments made to a female member of staff at the CBI. Well, Barrett's board said today it was in the best interests of the company to accelerate a planned transition to a new chair to prevent the ongoing impact of the allegations against Mr Allen from becoming disruptive. The investment banker Caroline Silver will replace John Allen as Barrett's chairman. RS Group, the electrical components distributor, warned this morning that trading during the last 7 weeks had pointed to a slowing in industrial growth. The FTSE 100 company also said it was seeing continued weakness and aggressive competition in electronics. Well, the update came as RS, previously known as Electro Components, reported a pre-tax profit of £371.5 million for the year to the end of March. That was up 23% on the same period a year earlier. RS said that sales growth was strongest in the Americas, where it benefited not only from an acquisition, but also price increases. The Norwegian chemicals company Yara International said this morning it's to build a new fertilizer plant in Yorkshire. The company said the plant would produce specialty crop nutrition products and biostimulants designed to increase farm yields and improve quality. It said the site would be located at Howden, near its existing site in Immingham, and is aimed at doubling its UK production capacity. The aim is for the facility to become operational by the end of 2025. Well, equity markets in the Asia-Pacific region traded largely to the downside overnight amid unease over the US debt ceiling. The Nikkei in Tokyo, which recently hit a 33-year high, fell along with Hong Kong, Shanghai and Sydney, although there were gains in Singapore and in Mumbai. Well, in Europe, stocks are also trading to the downside this morning. You can see there all the main continental European indices in negative territory right now. Talking points today include the Danish drugs giant Novo Nordisk, Denmark's biggest company by some distance. The shares are off 2% in Copenhagen amid concerns of growing competition to its weight loss drug Wegovy. Well, here in London, the FTSE 100 is just about in positive territory. It's more or less unchanged there looking at that. Losses for industrials are balancing out gains for some of the property heavyweights this morning. The leading blue chips are indeed Land Securities and British Land, both of which updated the market last week and both 2% to the good there, as you can see on the screen. To the downside, well, the leading faller, mentioned them a moment or so ago, is RS Group. That's on its results. Outside the FTSE 100, Pennon Group is off by 1.75%, and that is after Ofwat launched an investigation into leakages at its South West Water division. Among the gainers in the mid-caps today, well, the meat producer Cranswick, its shares are nearly 4.75% higher as its results have been well received today. Meanwhile, Watches of Switzerland, a company that we've featured quite often in the recent past on this programme, its shares ahead by some 3.5% on mounting speculation that the government is to reintroduce VAT-free shopping for tourists. That would be a huge boost for that particular company. On the foreign exchange markets, well, a bit of breaking news in the last hour. We've had the latest Flash Purchasing Managers Index survey data for May. Obviously, anything over 50 represents growth there. Anything below that represents a contraction. The reading for April for May came in at 53.9. That was down from 54.9 in April. As you can see, the pound has sold off on that news. It's off nearly 1/3 of 1% right now against the US dollar. It's off 1/7 of 1% or so against the US dollar. The single currency, meanwhile, off 1/8 of 1% or so against the greenback. As for the oil price, it's been very little change this morning. Not much going on there to talk about. Barrel of Brent crude currently off 1/3 of 1% right now. That takes a barrel of Brent crude to $75.73 a barrel. Well, joining me this morning is Ian Quigley. He's Head of Financial Planning and Investments for Ireland at Brewin Dolphin. Ian, good to see you again this morning. We're reaching the end of the latest quarterly earnings season. What have been your takeaways?
Biggest takeaways, probably the resilience and the recovery for some of the big US tech companies, which have reported better numbers. And they're obviously a big part of the global market, big part of the US market. Outside of those companies, you've seen a decline in year-over-year earnings, but better than what was expected. Earnings estimates were revised down beforehand, so nothing too calamitous. And interesting, when you look at market history, when companies have reported modest declines or very modest gains or modest declines, it's been fine for the equity market because often the market anticipates a decline in advance like it did last year. So from here, it'll be more about how earnings will get revised as the year progresses and how the economy performs. But the earnings season was fine and probably better than most expected.
It absolutely is. I mean, no sooner has the market got over worrying about that there than we've got this US debt ceiling situation. I mean, tell me the US isn't going to default on its debts, please.
No, well, yeah, I think it's this classic kind of prisoner's dilemma / game of chicken that we're seeing at the moment. And I think logic will prevail. Markets assume that logic will prevail and they'll increase the debt ceiling. It is obviously the case in US politics that it's become more polarized over the past decade. So you can understand why, in all likelihood, it's going to go down to the last minute. So both sides can sell it, particularly the Republicans, to the more extreme part of their party. And again, we kind of all anticipate that that's what's going to happen, but you're kind of going through this dance. But with the extreme shift in part of the Republican Party, that probably makes it a little trickier than previously. But you would assume logic will prevail there.
Yeah, we all have to be experts on the Republican Party's ins and outs at these sort of occasions. But I mean, it strikes me, and this is being used as a bit of a sort of catch-all. When the market feels like going down, people will just sort of attach themselves to that particular story.
Yeah. Well, that's often the case, isn't it, with markets, whereby if markets go up, you find a narrative to explain why it went up and vice versa. I think reflecting on the last year and this year, if you recall, as I'm sure you do, at the end of last year, start of this year, the overwhelming consensus was that the start of this year was going to be very difficult and we might get a rally into the second half. Lo and behold, most European markets are up double digits. Nasdaq's up 20-odd%, and S&P's performed very strongly as well. So it's moved counter to what the consensus expected, and gets often the way with markets. And from here, clearly the debate, as it was through the second half of last year, when will the economy go into recession, or if it goes into recession, what type of recession that will be, and it'll be those discussions around the economic cycle will be forever at the forefront of people's minds. I know for us, we've got to place the emphasis on investing for the long term, because again, if anything, the last 6 months, a year just shows you how difficult it is to predict the economy.
Absolutely. And obviously that feeds into interest rate expectations as well. I mean, we haven't talked much about the Eurozone this morning. Where are your thoughts on where the ECB goes from here?
Well, they're saying they're going to do more. Sorry, I should have looked at the futures before coming on, but they say they're going to do more. Lagarde's still talking pretty tough. It is quite remarkable to think in March last year, German bonds were negative yielding. And now 1-year German bond is 3%. So it's been a hell of a move. And perhaps, we see it here in Ireland as well, and across the Eurozone. That's not really flowing through the banking sector, because banks aren't paying particularly high interest rates, or it's not necessarily flowing through in lending rates either. So there might be a bit of delayed effect of that. You can see it in asset prices. You can see it in the sectors that you expect to be most vulnerable, like property last year. But perhaps it's going to take a little bit of time for the moves that have already been taken to flow through to the economy. You would expect it to slow the economy, and you would expect interest rates perhaps to ultimately come back to a lower level. But it's just how far central banks want to go, how worried they are about inflation, and how patient they may or may not be about it coming down.
Absolutely. Ian, always good to see you. Thanks for joining me today.
Thank you.
Nip across to Westminster now. MPs on the Treasury Select Committee are questioning senior figures from the Bank of England, including the Governor, Andrew Bailey, and the Chief Economist, Hugh Pill. Mr Bailey's just been asked why inflation is higher than when he last appeared before the committee. We're just going to listen in.
Signs of that, because obviously the peak was 11%, and we have seen the benefits already of some of the benefits of energy prices. But it is higher than we expected to be, and there are two underlying reasons for that we see in the data. One is food, and the second one is some goods, particularly clothing and footwear. Now, I should just make the point that it's interesting to note that those are not the elements of inflation that we regard as the more persistent elements. That's more in the services sector, where so far it's tracking more or less as we thought it would in February. But we have seen, you're right to say, we have seen these upsides on these particular two areas.
So what's gone wrong then, either with your models or with your network of agents? It's not something that any of us would have found surprising, that food prices, for example, were persistently strong, that our farmers were telling us about how much inputs were costing them and things like that. Something has gone really wrong with your modelling and with your network of agents, which is meant to give you this edge in terms of information. On
food, let me say, it's obviously a question that we've spent a lot of time on as well, as you can imagine. What I would say is that back in February...
2023?
Yes, this year, sorry, yes. The contacts that our agents were talking to, this was a point when food price inflation, I think, was around 15%, if I remember right. That's the food element. And the contacts were telling our agents that they thought that was the peak and that it would come down from there onwards over the rest of this year. Now, you're right, that has turned out not to be the peak. We've invested a lot of time and effort, including me going around the country, talking to the contacts again to say what has caused this to happen. I should say that they remain of the view that it is going to come down. But it's gone up in the meantime. Now, there's two reasons that I would say, or two groups of reasons. They give and they say, look, they were wrong in this view. The first group is things that I think it's reasonable to say couldn't have been expected. In other words, events that have happened in the meantime. in certain elements of food, and they're mainly weather events around the world, frankly. So there was a well-known thing with vegetables in, I think it was Morocco, particularly. Sugar is the one commodity that is still, when across the board, whose price is still rising. There are a series of weather events in other parts of the world given for that. So there's some things like that. There's also a story about avian flu. Those things are things that I think genuinely, you can't predict from from period to period. I think the second thing, it is, however, the question, and it goes to what you were saying a few moments ago. And I think two things I get told, and I was on a farm last week, actually, talking to a producer who's also a producer of final output as well. And they said two things. One is energy. The impact of energy prices on businesses is quite unevenly distributed. It's not like domestic energy, household energy prices, which have been, in a sense, set by government policy. It really depends on when you renew your energy contract. I mean, you may pick this up in your constituencies. Some businesses, have done much better because the timing of the reset of their energy contract worked in their favour. Some have had the absolutely opposite effect, and so it's very uneven. I think the second thing is, and this is perhaps where the prediction issue comes in, I think what was possibly underestimated is the degree to which food producers have purchased more forward in terms of raw material supplies than they would normally do. And in other words, they've locked in higher prices for somewhat longer. And the reason they did that is related to Russia-Ukraine, actually, which is they were worried about the actually getting hold of stuff. So the farm I was on last week said they bought fertilizer further forward than they would normally do, locked in a higher price than that. Now, I think that I think you're right. It should have been possible to identify that, I think. I mean, it's a bit harder to quantify, but it was in there somewhere in the mix, whereas the weather events weren't.
And we'll be coming back to food later on in the session. But if I can turn to Hugh and ask the same question, do the responsibilities for the forecasting models fall within your area, Hugh?
Most of them do, yes.
So what's gone wrong with them?
Well, I would echo a lot of the things that have already been said. It is very difficult to forecast at very high frequencies some of the developments that we've seen, given the magnitude of the shocks and their pass-through.
But to take an example, in the Governor's letter to us, which we're...
Well, if you want to continue watching those questions to the Bank of England executives, you can click on the QR code on the screen, which will take you now to our live feed from the Treasury Committee. In the meantime, we've got a bit of breaking news for you. The pandemic, the war in Ukraine and climate change. No, we're not coming to that first. We're going to talk about the Shell AGM, which is taking place right now. There has been some disruption at the Shell AGM. Some climate change activists have got into the meeting. I think we can show you a quick clip of Sir Andrew Mackenzie, the Shell chairman, dealing with some of these people. Let's just see if we can get that to you. That's Sir Andrew Mackenzie there, the Shell chairman there. Disruption was protested. It's worth actually pointing out most shareholders in Shell are a bit peeved at just how much the company is spending on the transition compared with some of its American rivals such as Exxon and Chevron. But we will have more on that throughout the morning, no doubt, here on Sky News. Now, the pandemic, the war in Ukraine and climate change have all highlighted vulnerabilities in the food supply chain around the world, creating shortages and pushing up prices. But the global food system is also going to be subject to other enormous changes in coming years, including changing preferences, chiefly for a more Western diet, as well as technological innovations such as crop science and lab-grown meat. So how should investors navigate these changes? Well, joining me is someone who's just written a paper on it, Taimur Hyat. He's Chief Operating Officer at PGIM, the $1.2 trillion global asset management company. Taimur, good to see you this morning. I couldn't work out from reading your paper whether you're actually optimistic or pessimistic about the outlook for global food.
I am convinced that it's at a cusp at a point of transformation where clearly the food system as we have it now, Ian, is not fit for purpose. The system's broken. You've got 25% of people in the G8 obese and overweight, and you've got 800 million malnourished people at the same time. The Ukraine war has just shown what geopolitical tensions and energy price increases can do to food inflation and food prices. And you've got this three-tier technology in food where you've got like precision agriculture in the US and Europe, you've got large-scale mechanized farms in Argentina and Brazil, and then you've got bullocks and farms less than 10 acres in India. So it's ripe for change, and there's lots of opportunities for investors behind that change, but we feel that change is desperately needed because climate change is really exacerbating all these tensions that I've just described in the food system.
Would an agrarian revolution in China and India along the lines of what we had in this country a couple of centuries ago help the efficiency of food production in those countries?
Absolutely. A lot of the technology, the sensors, the way to measure water, all these places where there's opportunities in venture capital to invest have sort of got limited to the US, to the Europe, and to Latin America. And you have small-scale farming, and this technology hasn't adapted to the needs of those countries. There are new companies, for example, there's Gramophone in India, a small company that's on mobile devices providing Indian farmers information on seed technology, when to plant, what are satellite weather patterns looking like. That is all needed because Indian, Southeast Asian, African technology really hasn't advanced since the 1960s Green Revolution. And a lot of advances have come elsewhere that we need to sort of adapt to those worlds. And that'll cause a big increase in food production, which is again going to be down 12% just because of climate change. Which is really alarming. I mean, you make the point that Western-style diets are going to be the growing preference. I mean, that is more resources intensive. Can production keep up with those changes? Production can keep up with those changes. It will require this big modernization of the farming system, and it does create some interesting opportunities for investors. So one example is meat production. Now, you want to go at the greener end of meat, places where the methane and other sort of risks are manageable. But really, the affluence in Asia is going to meet much more meat production, much more diets that are similar to Western diets, and a whole range of opportunities in these sectors that's actually much more resilient, we feel, as an investment trend than plant-based meats and others, which are languishing at 0.2% of meat consumption. Yeah, but you're also quite sceptical about the prospects for the cultivated meat sector. Cultivated meat, you can get chicken nuggets now in Singapore. Israel's doing some work, but it's pretty limited. Essentially, there are about hundreds of firms, all small, very unclear as an investor which one will succeed, which one won't. I think it's much more a place where government comes in and does primary research, and we're still 10 years away where investors find a clear winner where they should go after that. And in particular, it's going to be easier, and I think for much simpler proteins. We are not going to have sort of prime rib steaks out of cultivated meats over the next 10 years, but you might get egg whites that go into cakes and so on that will be created through these means. That's probably where investors should go, but more in VC, and I think still where government rather than private investors will find opportunities over the next 5 years. All right, Taimur, there's so much more I wanted to ask you, but I'm afraid we're out of time. But it's a fascinating paper. Thanks for talking it through with us. Thank you. A bit more breaking news to bring you now. The Duke of Sussex has lost a bid to bring a second High Court challenge against the Home Office over his security arrangements when visiting the UK. Our royal correspondent, Laura Bundock, has the details. Laura.
Well, security has always been a hugely contentious issue for Prince Harry ever since he left his role as a senior working royal. He's not entitled to security or automatic police protection when he or his family are in the UK. He was challenging that decision, and this case was in particular about the decision not to let him pay for his own protection. Now, Harry's lawyers had argued that this question about whether or not he could pay for it had not been taken correctly. He said that it had been taken by which is this executive committee for the protection of royalty and VIPs. And it should have been taken, his lawyers claim, by the Home Office instead. They'd argued that under the Police Act of 1996, there was provision for private individuals to be able to pay for their own policing. However, when this preliminary hearing was heard at the High Court, the Met Office made it very clear they thought this would be unjust, that you should have wealthy individuals able to pay for their own policing. policing, that it was not a fair decision, not a fair situation, and it wasn't right that the richer people should be able to pay for policing this way. Harry has lost this appeal. He was wanting a judicial review into the decision. He has lost that bid today. This is just one of a couple of cases he has about this decision regarding his security. He's also challenging how that original decision was taken. And don't forget, we've also got the phone hacking cases underway as well at the High Court as well. The most important, the most prominent of those is this full trial at the moment against Mirror Group newspapers. But the breaking news today is that Harry has lost one of his bids about the security situations. He will not be able to challenge this decision taken that he cannot pay for his own policing.
OK, thanks, Laura. Now, recent updates from the commercial property sector have pointed to the damage done to the sector over the last 17 months by rising interest rates. They've impacted some property valuations as well as hitting development activity. Well, today, Ashura, the leading primary care property investor and developer, reported a pre-tax loss of £119.2 million for the year to the end of March. That compared with a profit of £155.8 million in the same period a year ago and reflected a write-down in the value of the company's property portfolio. Well, joining me now for more on this is the Chief Executive of Ashura, Jonathan Murphy. Jonathan, good to see you again this morning. I mean, the key point here is this is a non-cash write-down and your rental income was actually up 9.1%.
Yeah, absolutely. I mean, you said at the start that all commercial property companies have been impacted, and I'm afraid we're no different. So, yeah, but overall, we had a 6% write-down in the property value. That's a lot less than most other companies have seen, and that reflects the fact that, you know, all our buildings are occupied by government-backed tenants who've got very long-term, secure tenancies in place, and the cash flows are rock solid, as you say. So, you know, 9% growth in our net rental income, which has given us the confidence to announce another increase in the dividend. So, yes, we feel, of course, we're affected, but we feel we're in a very strong position.
Good to hear. Now, at the tail end of last year, you said that you were going to be slightly more cautious about developments in the near term. Has anything changed since then to alter your thinking?
Yeah, no, we remain active. So we're on site with 10 schemes at the moment, and we've got plans to start 5 schemes. You know, but if you asked me that question 6 months ago, we probably were looking to start in double digits. So yes, we are reducing the number of new projects, and those are, you know, essential healthcare facilities that we were looking to deliver. But the problem we've faced is rising construction costs. Yeah, I'm sure you've read about that for the house building sector as well. So, you know, with those rising costs, it takes we then need to pass that on, unfortunately, that extra cost to the NHS in terms of higher rents. And that's going to take a long time in terms of those negotiations. So we're just moving a little bit more cautiously on some of those developments. But all those projects are still required. We're still very confident we will deliver them, but just probably going to take a little longer than we would have liked.
What would you need to see, Jonathan, to make you start deploying capital a little more aggressively?
Oh, it'd be very straight. I mean, if we were able to achieve, you know, the increased rent levels that the costs are requiring, if the NHS was able to meet those additional costs, then we would be willing to start the projects tomorrow. You know, those are conversations that we've got going right across the country. We've got projects right across the UK that we're looking to roll out. And in some places we are seeing agreements on those increased costs, and we will press on with those. So yeah, an increase in the overall rent position would enable us to move much faster on these new projects.
You mentioned you were seeing higher development costs. Give me an idea of the sort of scale of the increases that you've been experiencing.
Well, over the last 2 or 3 years, it's in excess of 50%. So, I mean, very significant increases. I mean, currently, what we're asking the NHS to fund to reflect that, you know, is probably a minimum of a 30% increase in the rent level, which is very challenging, of course, you know, for the NHS at a time when the budgets are under pressure. But the lack of facilities also causes costs in the system in other ways. So, you know, if you can't be treated in a community facility in your GP surgery and you have to go to hospital, that's much more expensive for the system. So it's a little bit of false economy, unfortunately. If we could invest in modern out-of-hospital facilities, then overall for the NHS that would see costs fall. But, you know, in the short term, it's an increase in that rent level.
Now, we've talked about this before, Jonathan, but for the benefit of new viewers, give me an idea of how often rents are reviewed in the portfolio.
Yeah, we have a standard agreement with the NHS. So we typically have a 21-year lease, and we look at the rent every 3 years. And every 3 years, it's assessed in light of the rent levels for other medical centres in that location. So it's a 3-yearly rent review pattern. Now we have other tenants like pharmacy tenants, where it's just based on indexation, so it looks at CPI. But for the NHS, it's effectively an open market review every 3 years.
Now, you've also got a growing Irish business. What are you seeing in Ireland?
Yeah, no, Ireland is got very similar drivers to the UK. So, they have a need for investment in out of hostel capacity. We've got 2 projects that we've completed. We're on site with another 2, and we've got 3 starting shortly. So it's a very similar market to the UK in terms of that need for investment. And we see significant scope for us to expand over there as well. So small scale at the moment, but clearly plenty of potential for further growth over the Irish Sea as well, yes.
Now, in the recent past, you've not been afraid of disposing of property assets where you've seen the need to. What are you doing on that front right now?
Yeah, so I mean, clearly the markets are more challenging. So you've got to look to self-help in terms of looking to fund the growth in the business. So we disposed of 65 assets in the first half of last year, and we were able to sell those at above book value. That's a fantastic outcome in this market, and I think that reflects the fact that there is still real interest in the market in healthcare assets such as ours. People recognise the long-term trend, the need for increased capacity in the space, and so they're still very attractive. So yeah, we will continue to look at further disposals as we move forward because we want to provide that flexibility to enable us to move on those new projects for the NHS as soon as we can get those rents agreed.
All right, Jonathan, we've got to leave it there. It's good to see you again this morning. Thank you.
Brilliant. Thank you very much.
Time now for a look at this morning's business pages, and the Financial Times splashes its print edition with a story we brought you this time yesterday: the record €1.2 billion fine meted out to Meta Platforms by the EU. The FT is currently leading its digital editions, meanwhile, with an interview with Rachel Reeves, in which the Shadow Chancellor tells the paper that a Labour government would be prepared to force pension funds to invest in a proposed £50 billion future growth fund. It would have 5% of every defined contribution scheme's assets invested in it. Daily Telegraph splashes its print edition with an interview with Sir Nigel Wilson, the outgoing Chief Executive of Legal & General, in which he tells the paper London is falling behind rival financial centres as a result of over-regulation and misguided political interventions dating back to Gordon Brown's tax rate on pensions. That's 1997, I remember it like it was yesterday. It leads its business pages, meanwhile, with news that the entrepreneur Mike Ashley is mounting an incursion onto the board of the luxury handbag maker Mulberry, in which his Frasers Group owns a 37% stake. The Times, meanwhile, it leads its business pages with the Meta fine, but it also reports on a court case yesterday in which the businessman Anthony Constantino has been found guilty in his absence of a £70 million fraud that promised investors a 60% annual return. Well, with me today is Jurgen Meyer, the UK industrialist and former chief executive at Siemens UK. Jurgen, good to see you this morning. Let's start with these comments from Rachel Reeves, because she goes on to say this was actually the brainchild of Nicholas Lyons, the Lord Mayor of the City of London, and she and Labour are embracing it.
Indeed, yeah. Well, look, as you know, Ian, I'm a massive fan of startup, especially startup technology companies, and they do need more investment, especially early stage capital. So on the one hand, I think this is fantastic news. What is really interesting, as you say, is that this is the Labour Party, Rachel Reeves, proposing this. You would normally see it as more of a Conservative policy, but look, let's take that as positive news that politics is agreed on this. I guess what will raise some eyebrows, however, is the use of the word force. So this is implying that it will be legislated that pension schemes, yours, mine, every one of your listeners today, that 5% of their private pension can be invested in these startup companies. And of course, that goes with some risk. And I suspect there will be quite some discussion about who really has the responsibility for that risk. Can the regulator do that, or should the trustees of the pension scheme be able to ultimately decide? So, look, it's a good discussion, a good debate, but I think there's some discussion to go.
Yeah, completely agree. We actually had Nick Lyon on the programme when he first proposed this, and I sort of put it to him, this smacks a bit of North Korea telling pension funds what to invest in. He pushed back at that.
Did he? Yeah, well, look, like I say, the intent is right, and we probably have become too risk averse in our pension schemes, but I personally would fall short of forcing trustees to have to do this. I think it has to be an encouragement and an incentivization mechanism rather than legislation.
Yeah, it's all about the incentives, isn't it? Now, you've alighted on another story in the FT here. Post-Brexit, UK investments drive FDI in Germany to record levels.
Yes, and this is fascinating, especially for somebody who spends a lot of time in Germany and the UK. Now, it's been widely reported that the UK has sort of lost its shine on foreign direct investment, and that indeed the pole position within Europe is now held by France, not the UK. But what I hadn't appreciated, and probably many of your listeners, is that our outflow of investment, so British companies investing in Europe, that has gone up, and it's particularly gone up into Germany. Indeed, the article here is saying that it's risen by 21%. Over the previous year. And what this is showing is that it is British companies looking to invest in Europe, using Germany as a key location, because those companies want better access to the single market, which is, of course, restricted to us otherwise outside of Brexit. So, look, the summary is the UK remains a strong place for foreign direct investment, also as an outward investment, but Brexit has clearly taken the shine off it and is meaning that we're actually exporting more of our investing than importing.
Yeah, it's an interesting piece. Jurgen, we have to leave it there, I'm afraid. Good to see you this morning. Thank you.
Thank you. Bye-bye.
More breaking news to bring you. The International Monetary Fund has said it is not now expecting the UK to enter a recession this year. Well, joining me now is our economics editor, Ed Conway. I mean, Ed, quite a few other forecasters have said this year. IMF playing a bit of catch-up here, is it?
Yeah, I mean, it's a big change from their previous forecast. But to be honest with you, and, you know, I remember we had exactly this conversation about the reliability of any forecast right now, to be honest with you, but in particular IMF forecasts, the last time they made a forecast about the UK, which was to say that Britain was going to face the weakest economic growth in the G7 this year. That was widely reported at the time. It was what the IMF was saying, and it was quite a big, it was a big call to say the UK was going to have a recession, and then most other countries around Europe and indeed the rest of the industrialised world were going to do a lot better. But now it's pretty much a reversal of that. They are saying that the UK is not going to face a recession this year. It's going to be 0.4% growth, not very strong growth, but nonetheless a lot better than the minus 0.3%. I think it was minus 0.5% previously. They upgraded it a little bit, and now they've upgraded it even more. And also there will be other potentially economies within the G7 which will do worse than the UK this year. You were just talking about Germany. It looks like German growth is forecast by the IMF to be kind of close to zero. So the UK at 0.4%, as I say, nothing to write home about, but nonetheless a lot better than we previously saw. It's actually no longer the worst performance in the G7 in 2023. So that will be seen as a big victory for Jeremy Hunt, or, well, I mean, a minor victory, but nonetheless a victory compared with where they were before. The big picture, though, the UK pretty much kind of, if not flatlining, then very weak growth for the next few years. Still very high inflation. In fact, they've pushed up their forecast for inflation. They say the Bank of England may have to do, or they're recommending the Bank of England should do more interest rate hikes. You can see Andrew Bailey, that just there is being quizzed by the Treasury Select Committee right now. And inflation's still a big pressure in the UK. But really, it's that big headline number that I imagine most focus will be on. So much noise. I think it was towards the start of this year when the IMF said the UK was going to fare the worst in the G7. Well, that is no longer the case. They say the UK, it's not necessarily going to be going gangbusters this year, but at 0.4% growth, no recession, and no longer the weakest growth in all of the G7.
All All right, Ed, thanks for that. Now, a report published last week by the business services group PwC in conjunction with the UK Space Agency revealed that after the United States, the UK has become the most attractive investment market for private investment in space. Well, since 2015, the UK has received 17% of global investment in the space sector, with UK space organisations receiving investments from at least 7 of the most active global investors. One of the leading investors in space tech is Seraphim Space Investment Trust, which today reported a £500,000 drop in the value of its portfolio to £180.5 million for the 3 months to the end of March. Joining me now is the Chief Executive of Seraphim Space, Mark Boggett. Mark, welcome to you. I mean, your share price is trading at a 59% discount to net asset value. What is the market not getting right about your portfolio?
Yeah, well, the good news is, from our perspective, is that our peers, who also are public companies investing into private companies, are also sitting on similar discounts. So it isn't necessarily focused on space or on Seraphim. It's really on the asset class that we invest into. But the valuation is significant. Our market capitalisation, £90 million today versus net assets of 222 million. So taking into account our 40 million of cash, that means that our portfolio is valued at just 50 million. Now, our largest portfolio company, ISI, is valued at 43 million. And that company's just completed its best ever quarter. Record levels of revenues, record levels of bookings. They've just announced a major milestone deal with the UAE government. So our biggest company is absolutely thriving, as are many of our companies in our top 10 and beyond. You know, the PwC report that you referenced there really does demonstrate real growth in the market. There's another huge driver that's been going on during the course of the last quarter that's impacted our portfolio, and that's around change in regulation. So you'll be aware of debris in space, and the increasing number of satellites that are being launched have the potential to increase this debris. And the regulators have now focused on that. And the FCC has now changed the rules so that you have to remove a satellite at end of life after only 5 years. Previously, that used to be 25 years. So that is really impacting 3 of our portfolio companies. Deorbit has had their best ever quarter. They've had multiple successful launches. They've won a handful of contracts that are worth tens of millions of dollars. Our Japanese company, Astroscale, has just closed a massive funding round, $75 million at the price of last year's funding round. And our other portfolio company in the top 10 that's focused on debris in space, Leo Labs, is having a really strong period as well. So our pedestrian numbers are really not sort of reflecting what's going on in the actual underlying portfolio.
Good to have that detailed breakdown, Mark. I mean, the broader picture here as well is that the cost of accessing space is coming down quite sharply. I mean, presumably that is driving investment as well.
Yeah, absolutely. That is what's been driving investment into the space market during the course of the last 4 or 5 years. They're led by SpaceX, but there's 150 other rocket launch companies behind them using reusability, 3D printed components. And then we recently saw SpaceX launching the world's largest rocket, their Starship. That is really single-handedly going to reduce the cost of sending a kilo into space, some believe by at least a further 50%. So the direction of travel is also positive for the types of companies that we invest into. And it opens up the market to a much, much broader range of commercial activity.
What's driving demand right now? I would assume that defence is a higher priority than once was the case.
Yeah, absolutely. Well, because of the geopolitical situation in Ukraine, we're now in a period where defence budgets around the world are at record highs. And space is really at the top of their priority for new capabilities that they're looking to invest these budgets into. The number of portfolio companies through Seraphim that are operating and supporting activities in Ukraine has really shone a light on the capabilities of these companies that are providing data and communications from this new digital infrastructure in the sky. The other driver is climate and sustainability. The vast majority of our companies are dual use. They support defence, but they also support climate. And with climate-induced weather events just increasing around the world, there is a need to better monitor and protect ourselves against those. And the types of companies that we invest into are very much focused around that. And as a consequence, their revenues are driving positively.
All right, Mark, got to leave it there. Good to see you this morning. Thank you.
Thank you.
Now, Ryanair's results yesterday, along with other recent trading updates from the likes of EasyJet and TUI, have highlighted the strength with which the travel and tourism sectors are bouncing back, all of which has benefited SSP, which operates restaurants, bars, cafes and other food and drink outlets in airports and railway stations around the world. Well, the company, whose brands include Upper Crust and Ritazza, today announced an underlying operating profit of £34.4 million for the 6 months to the end of March. That compared with a loss of £36.4 million in the same period last year. SSP also announced a partnership with Brewdog that will see it operate a number of Brewdog bars at airport and railway stations in the UK to be opened over the next few years, the first of which will be at Gatwick Airport. Well, joining me now, I'm very pleased to say, is Patrick Coveney, the Chief Executive of SSP. Patrick, good to see you this morning. I mean, it's fair to say that while there is a bounce back, it's been fairly uneven, hasn't it? I mean, the US has kind of led the way.
Yeah, no, it looks that way, but it's actually surprisingly consistent. So what I mean by that, Ian, is our business in the air channel in aviation. You referenced Ryanair earlier. We're seeing that be strong everywhere, and so we're now essentially back to where we were in traveller numbers pre-COVID, and our business in America is 100% air, whereas if I contrast it to our business in the UK, which is about half rail, half air, the mix effect of that means that the UK growth doesn't show up as strongly as the US, but it's really a function of rail taking a bit longer to recover than air.
Is that because the rail strikes have hit commuter activity?
Well, I think it's been amplified by the strikes. But I think even separate from that, you still have flexible working from home, a somewhat lower level of commuting than you might have seen pre-COVID. Whereas in the air channel, people are just taking holidays in a kind of really, really full-on way. And that strength of leisure travel is underpinning the very, very rapid recovery in the air business across the world, which you haven't yet seen to the same extent in rail.
Now, you've stepped up site openings over the last 9 months or so, the US particularly, but also markets like India, Malaysia and Thailand. What do you look for when you open a new site?
Yeah, I mean, we're looking for three things, really. We're looking to put sites in high growth markets. We're looking for sites for regions and business models in which we think we can make money. And we need to have kind of the trust and confidence of typically the airport terminal owner and the brands that we bring there. So some combination of our own economics, structural growth, and a genuine spirit of partnership.
Now, this is the first chance we've had to speak to you since you joined SSP. We've spoken to you previously when you were at Greencore, of course, a major supplier to SSP. What's it been like moving around to the other side of the table?
I tell you what, it's been fun to go to the other side of the table after 15 years of being in one part of the food value chain. It's just, I mean, on a serious note, Ian, the change for me has been really invigorating, and it's been a lot of fun. And I don't pretend that one part of the value chain is any easier than the other, but it is a little different, and it's been refreshing for me to make the change, and I'm enjoying it immensely.
That's good to hear. What about food and drink inflation right now? What are you seeing coming through the pipeline?
Well, listen, the whole industry has been smashed by inflation for the last 15 months or so. And you see that with the understandable now public policy focus on food pricing. But it's really a function of very, very significant pressures that have been put on supply chains, which have driven up costs. So my expectation, which is also our planning assumption, is that the rate of inflation will begin to ease through the rest of this year. But we're still a bit of a distance from deflation and any meaningful reductions in food pricing, I think.
How difficult has that been for you with some of your premium offerings? I mean, upper crust, the clue is in the name. This is a premium offering. Has it been difficult to pass on price increases in certain segments?
Well, I think we're very fortunate relative to other retailers, other food service operators, or other participants in the food industry, in that we tend to operate in locations where consumers choose to be less price sensitive than they might otherwise be, because we're typically providing food for people when they're having some kind of a treat, right? Going on a holiday, going on a weekend away, and in that environment, provided we get the service right, the culinary credentials right, provided we reduce stress and don't run the risk of being slow and contributing to customers being stressed out whether they're going to get their flight, we don't tend to see the same level of price elasticity that you see in other channels. And so what that's meant is we've got to be careful about this, but where we've had to recover inflation through pricing, we haven't seen the types of elasticity effects that you might see in other channels. Now we keep monitoring that, and we want to make sure that we do have propositions that cater for very price conscious customers. But in general, what we find is that consumers are willing to pay a bit more when they're going on their holiday, and when they're getting a very, very good experience in an airport or rail station.
Yeah, that figures. Now, tell me about the tie-up with Brewdog. Was this their instigation or yours?
Well, I think it's both, actually. I mean, we're constantly on the lookout for brands and concepts that we think will work in a travel environment and that we can somewhat travelize, to use that expression. In other words, figure out a supply chain and a staffing model, and a kind of capital build and a business design that works in a travel environment. We think the world of Brewdog as a brand and as a proposition, and it's part of a kind of revitalization and excitement that we're putting into our UK business. And so it's not the only one. I mean, we're psyched to be announcing this today, and you're going to see it in Gatwick later this summer, and you'll see it in a number of rail stations by the end of the year as well. And it's a privilege for us to be able to bring a iconic brand like that to a travel environment. So we're delighted to be doing it, and we'll have to do it well. We also have other brands, though, that we're bringing this year. We're bringing the Breakfast Club to Gatwick. We've actually, we've launched and travelized 3 Greggs outlets, 2 in rail, 1 in air, this year as well. So we're constantly looking to try to find the right high street brands that we can bring and make relevant to people when they're traveling.
Very good. Patrick, it's great to see you again. Thanks very much for joining me today.
Yeah, thanks, Ian. Stay well. Bye-bye.
That's it from me. Just a reminder, you can carry on watching the Treasury Select Committee by following the code on our screen. I'm back tomorrow on location. Meanwhile, we've got the Podco show. Hope to see you then. Cheerio.